Hey Legacy Traders, it's Tim Key with Option Legacy, helping you build a legacy through trading. So guys, I wanted to break down for you my process that I use, that I go through in managing and adjusting trades. Now let me tell you, trading should be like this, as mechanical and systematic as possible. You should actually be able to trade just by looking at numbers, not even looking at charts. However, I like to do both. I call it the hybrid of technical and mechanical trading, and that's what I teach in Legacy Trading course. And you realize that once probability is in your favor, because you're selling option premium, it just becomes about cranking through trades. Just crank through them, crank through them, crank through them. However, there's going to be times where trades go against you. So what are you going to do? So with it being noted that trading should be as mechanical and systematic as possible, leveraging high probability and specialized knowledge to be able to put the odds in your favor, I will say this, that managing and adjusting trades is probably the most artistic or creative aspect of trading. So with that said, every trader will manage and adjust trades differently. So I can't tell you what you should and shouldn't do. However, I can break down a few different options for you, and you can create your own trading plan to manage and adjust trades. And I'll tell you that every trader is going to manage and adjust trades differently based off of their risk tolerance. So let me give you an example of that. If you put on a trade and let's say it's a $5 wide strike and you take in $2.50 credit, your max loss there is $2.50 times 100, which would be a $250 loss. If you going into that trade said, hey, I'm 100% okay with having the max loss of $250 on this trade, and my goal is that this trade's profitable and I'll capture half of the profit that I received, then you might not even adjust or manage trades at all. You just open trades, you set your good to cancel, and then you let trades go against you if that's the case, and you take the loss if that's the case. So you have what would be considered a high risk tolerance. But other people might have in their trade plan understanding that if we manage losing trades to, let's say, a 50% loss, or maybe it's at 100% loss or 300% loss if you're going naked in a strangle or straddle or a short call or a short put. But let's say if we manage our losing trades, we can actually recoup some of that lost capital by managing it, actively managing it. It does take a little bit more effort, but if that's in your trading plan, I want to share with you a few different options. And really, I'm just going to share with you what I would do. So let's go look at a trade that was going against me, and we'll break it down, what I do, the step-by-step process of how I manage trades. So before we get into it, let me break down the step-by-step process. I'm looking at the expected move of that option chain. So the position that I'm in, the expiration, I want to see what's the expected move. In other words, if it's beyond my break-even point, can it come back down into that break-even point? If it can't, the expected move is shorter than what I need for it to come back down into my break-even point, or to come back up if it needs to move up, then I can't do anything about it. So it's just either close the trade, take the loss, or roll it forward, give it more time to come back into that. So I'm first looking at expected move. That's the technical, or that's the mechanical piece. Then I'm looking at a technical piece. I'm looking at the chart and I'm asking myself, hey, where are my break-even points? And from a technical standpoint, can it come down into those break-even points? So that's another piece of it. And then from that point, I'm then looking at, can I close out my current trade, my current position, for a smaller debit price than the credit that I can receive for rolling it forward? Why is it important that we take in credits whenever we adjust or manage trades? Because if you're looking to adjust or manage a trade, that means the trade's already going against you. So it's already at a loss. If we have to pay a greater debit to open a new position, so we receive a smaller credit to close out the current position, then the debit that we have to pay to open the new position, that means that we're putting loss on loss, or compounding our losses. So does that sound fun to you? Doesn't to me. So it's absolutely critical that when we adjust and manage trades, that we make sure and ensure that we can take in a greater credit for the new position or the adjusted position. So let's hop over into TastyWorks and look at a trade that's going against me. There's XLE, and the past 2 days it's had big moves to the upside and it went against us. So you can see that I ended up exiting this trade, and I'll tell you why as we go forward. But let's look at it. So you can't see, I was short or long here, but maybe from the activity, yeah, here. So back on March 2nd, where it's currently April 11th, back on March 2nd, we opened this trade. Sold to open the 66 put, bought to open the 61 put, sold to open the 67 call, bought to open the 71 call. And you can see here, it's already close to our long all the way through the call side. So it tested the call side. To open this trade, we brought in a $2.56 credit. Today, I decided to simply close out of the trade for paying a $3.05 credit or taking a $49 loss. So my max loss on here was $5 minus $2.56. So what is that? $2.44. $2.44 was my max loss, right? Is that right? Let's do a little bit of math. I'm not great with numbers. I use calculators. $2.44. Yeah. So my max loss here was $2.44, and I ended up deciding to take a loss of $49. So 49. I'm doing a little bit of math over here. Divided by 244. I took a 20% loss on here. 49 divided by 244. Yeah, I took a 20% loss. Decided to cut my losses and just move on with it. But what can we do when analyzing this trade? So let's go in to the option chain and look at what would be our current position if this position was still on. So you can see down here it's the identical to the position that we had, and I'm first asking myself, can the expected move, which I can see right here is $1.83, can that come back down into my break-even points? So how do I find my break-even points? I'm glad that you asked. I created this here for you, charted out in XLE, my break-even points. So I was short on the 66 put, short on the 67 call, I was long on the 61 put, and I was long on the 71 call. So to find your break-even points to the upside or the call side, we're going to take our short call and we're going to add in the credit that we received. So 66 plus 256 equals 260, or 67 plus 256 equals 269.56, or it's roughly this blue line. I got pretty close, 2 cents off. Wasn't able to nail it right down into it. And to find the break even to the bottom side here of this trade means I take my short put and I minus 256, and that gives me roughly a 63.46 or something like that break even credit down here. And so the goal is that at expiration, which is this blue vertical line that we see here, April 20th, that I need XLE to be under this blue line and above this blue line at expiration on this date. If it can happen, if it can close anywhere between those dotted blue lines, those break-even points, I make money. So can its current price, which is, where are you, current price, 270.64, I believe, is that right? 270.64 is its current price. Yeah, 70.64 is its current price. And the expected move, the first thing I'm doing is, can this expected move come back down into this price point here of 269.56? The answer is yes. So that's the first step I take. So if that's the case, I might just leave this thing and wait it out, not even manage it, just let it do its thing. I got into this trade, it had X amount of probability and an X amount of max loss. I was okay with that when I entered into the trade, so I might just simply let this one go and see what happens. The next thing I'm doing, once I first check the expected move to see if it can come back into my break-even points, I'm now going to the chart and I'm looking from a technical standpoint. Does it look like it can come back down into my break-even points by this date? So the mechanical piece, says yes, it can come back down. It's either plus or minus 183. So yes, from mechanical. Now from technical analysis, can it? And this is where I don't like it. I don't have set on here, but the 100 simple day moving average is right about here. Let's see if I can zoom in a little bit here. The 100 simple day moving average is right at this top of this candle body, and you see how it has that long wick to the upside? That showed me that it hit the 100 day simple moving average, tried to go higher but couldn't. And so that would be reassuring, except today it broke through the 100-day moving average, which is, you can't see it, I don't have it on this chart, but it broke through and continued to move to the upside. So let's say yesterday, if it closed right at that 100-day moving average while trying to go higher with that wick, and then today, if it bounced down, that would be reassuring that that 100-day simple moving average is acting as a resistance. However, with today's action of it continuing to move up, from a technical standpoint, this XLE position does not clear. I'm not hopeful about XLE coming back down under this blue line under this break-even point by expiration. So what could I do? Then the options that I have is essentially I could take the put side, so this 66 put and this 61 put, and I could roll them up closer to the current price of the underlying security, and in doing so I would widen my break-even points for this call. Let's say I took in a 50-cent credit, that means this break-even point would go up by 50 cents, giving it more room or having it closer for it to come down under my break-even point by expiration. That's something you could do, or what you can do is roll this thing out. So we would close out the position in this April monthly option, the same strike, same quantity. We would close the position and we would open up a new position out here in May, same strike, same quantities, same strikes and same amount out here in May, and just give this thing more time to possibly rally up and then rally down and come back into our break-even points. So again, whenever we're looking at rolling a trade forward or adjusting a trade, we always want to receive a credit to do so. So let's go back into TastyWorks and we can look at, is it possible to receive a credit versus paying a debit to adjust this trade? So to find out, this is aftermarket, so prices are going to be a little bit skewed, but to find out if you can roll this trade for a credit, you would just open up your current trade. So you would, go to your positions tab and you would, highlight these, right click, hit close trade. It would bring you to this screen populated, and you want to see how much it's going to cost you to close this trade out. So $3.02. Okay. Next thing you want to do is to find out if you can receive a credit by rolling this thing forward into the May expiration date. So to do that inside TastyWorks, you can just click here. Is that the May? Nope, one more strike. So we see that the bid by ask spread is very wide here, 287 by 317. That's simply because the markets are closed. This is probably, realistically, we could probably bring in a $3.10 credit, I bet, here. So if we close this thing for $3 and we'll say 5 cents debit, and we open up a new position with the same strikes and the same quantity, that's important. If you have one contract in the trade, or if you have 3 contracts, you need to match the quantity and you want the same strikes. So if we were short in the 66 in our original trade, then we also want to be short in the 66 and short in the 67, long in the 71, long in the 72. We're just simply opening up a new trade just at a different expiration with the same quantity. Could we receive, is 310 greater than 305? So we'd pay 305 to close this trade and receive a credit of 310. Yes, so that would qualify our position there. Now, so you could roll this thing. Oh, that's what I wanted to share with you. So why would there not be able to receive enough credit if you rolled the position forward? So in this example, I'm using April as our current position and looking at rolling into May. But sometimes that same strike, same quantity in that future or that going forward month, in this case it's May, sometimes you can't receive a big enough credit there. And you might think, why is that? Because you obviously have your selling time premium, so it should be more expensive because you're selling, it's 30 days or 30 plus days out, right? The reason why sometimes you cannot roll a trade forward for a greater credit than the debit you need to pay to get out of your current trade is because the IV, which we know implied volatility, puffs up or inflates option premium. The IV is higher currently in your current position than it is in that future position that you're looking to roll it out to. So since the IV is higher in your current position, it inflates or costs you more to close out your trade than the credit that you can receive in that future month trade, because the IV is not there to match it, or it's not equal and there's not enough premium to sell to match it. So that's what would create a debit. If there's a debit, in other words, you can't receive enough credit for that future rolled month, then do not adjust it. Again, because we never compound our losses. It's better to take a loss, max loss there, than it is to kind of snowball your account and continue to take losses. So you ask yourself, those are a few things. You say, Tim, you decided to close this trade out. Why did you decide to close this trade out? Well, one reason. For me, my trade plan, something that I wanted to do was simply take the loss, take it off the books, and look for another trade. A $49 loss in my account is not a huge loss in my overall account. I'm trading with about $24,000. Let's do 23. We're talking about 0.2% of my account. So for me, it was just, hey, let's go ahead and close this, rinse and repeat. We'll find another trade, make some money from somewhere else. So guys, I hope this added value to you. Again, you're gonna have to find out what your trade plan looks like. I call them if this then that statements. So I encourage you, even in managing trades, that you say, hey, if this happens, I'm then gonna do that. And even the way that you manage and adjust trades, that keep it absolutely as mechanical as possible, that will take your emotions out of it and put you on a firm foundation to adjust trades every time the same way, so that you can have consistent results in your portfolio, so you're not having these kind of all over the place results. And if you're more risk tolerant and you're okay with the probability and the credit that you received and the max loss that you defined whenever you got into the trade, you might not even adjust the trade at all. And especially as you're beginning to be new traders, it's, in my opinion, I think it's better for you to just simply let trades ride and get in correctly, open the trade correctly with the great probability, great credit, and then let the trade run itself out. Reason why, as a new trader, there's a lot of different pieces here, a lot of different techniques, a lot of different strategies that you can use in managing, adjusting trades, and it might be overwhelming. That's okay. The goal is to make money. So if you understand that probability is in your favor and you're entering into trades using the checklist, doing it mechanically, then it's, even if you have a losing trade, it's just about cranking through trades, knowing that probability is on your side, and then just look for another trade. However, as you begin to understand more of the basics and the foundations, and you want to become more aggressive in managing your losses, managing trades that are going against you, you can actually increase your portfolio's performance by doing different techniques. But I can't teach you or show you exactly what to do, because that's going to have to be based and determined upon what you think you should do. So guys, let me know, reach out to me directly. I would love to hear your comments and your perspectives on this video. Hope it adds value to you, and I'll see you on the other side.